American real estate markets are in trouble. And to be honest, it's not just American real estate markets. New Zealand, Australia, Canada, China, right around the world, we are seeing a lot of stress in the world's biggest damn asset class, which is property. Now, of course, this affects you if you own a home. This affects you if you have a mortgage. This affects you if you want to invest in properties. And this probably affects you if you exist in the human economy more broadly, because the impacts of a cool down in the real estate market are pretty damn impactful, because it drains wealth out of the economy as people's property prices go down and foreclosures go up and all these kind of things. It's very, very problematic. But how impactful is this, and how worried should we actually be? I want to break that down in this video for you. Make sure to tap on that thumbs up button, of course, if you do enjoy this kind of content, before we dive in here. And obviously, if you're not subscribed to the channel yet, you're missing out. You should get subscribed. Now, let's dive in. So, you are going to be hearing a lot of this. This is from Robert Kiyosaki. He, on X the other day, said, well, I'm constantly asked where the price of gold, silver, and Bitcoin going to be in 2025. My reply is that it's a silly question. More important question is, how many pieces of gold and silver and Bitcoins do you actually have today? Gold, silver, Bitcoin are bargains today, but not tomorrow. He says America is broke by GSBC today, gold, silver, Bitcoin today, before stocks, bond, and real estate crash. So this is what he's calling for. Like many, many other people, we hear this a lot, that there's going to be a big real estate crash. There's going to be a big stock crash. And I honestly think if there's a big stock crash, Bitcoin's probably not going to fare super well, because we have seen a strong correlation between Bitcoin and equity markets. But the real estate crash, of course, is more interesting for our conversation today. And we have had that echoed a lot, and there's a lot of worrying data out there. Real estate investors pull back, buying 45% fewer homes than they did a year ago. Investor home purchases fell 45% from a year earlier in the second quarter, outpacing the 31% drop in overall home sales, according to a new report from Redfin, the technology-powered real estate broker. That's the biggest decline since, wait for it, 2008. The year you never want to be compared to. They're doing the thing, guys. They're comparing it to 2008. That, of course, with the exception of the quarter before, when they dropped 48%. The decline comes as this year's relatively cool housing and rental markets makes investing in homes less attractive than it was during the pandemic-driven home buying frenzy of 2021 and early 2022, when, of course, the interest rates were low and you could borrow money for like 1.5%, 2%. Now, if you want to buy a house, you're going to be paying a lot of money as an investor, right? If you can buy with cash, fantastic. But not everybody has $1 million sitting around they can buy a house with cash for. Here's some interesting numbers for you as well. This all adds up to an affordability crisis. Imagine a house that cost $500,000 2 years ago and a family taking out a mortgage for 80% of the purchase price. At the then national average, a 30-year fixed mortgage rate of 2.86%. The monthly repayment would have been $1,656. Okay, now here's where things get problematic. Today, a 13.5% run-up in home prices since that time, that's the national average, according to the Case-Shiller Index, would push that home's price to $568,000 today. A surge in rates to 7.18% last week then results in a monthly payment of $3,077 for the exact same house. Because of the interest rates and the rise in home prices, you would now have to pay double, whether you're an investor or a regular home buyer. Investors, of course, very problematic. Makes it a lot harder to make the numbers work when that's the kind of money you have to be paying. You have to get a smoking hot deal to have that real estate investment work out for you. And for a regular person trying to buy a home, place for the kids and the dog and all that stuff, this is really hard too, because now you have to pay twice as much of your income to the banks. It's rough. People aren't buying houses. Kabezi letter guys here pointing out the real estate markets are about to do something that they have not done since 2005. At least he didn't say 2008, right? For the first time since financial crisis, existing home prices are about to pass new home prices. That's pretty crazy, guys. That's pretty crazy. So the yellow is new house prices, and the blue is resale house prices. The median new home sales price is now down to $416,000. Meanwhile, the median existing home sale price is up to $396,000. Existing home prices are on track to pass new home prices by December. Basically, what all that means is nobody wants to sell their house right now because they have 3% mortgages on them. They have 2.5% mortgages. Why the heck would you sell your house and go into a new mortgage where you're going to be paying 7.5% and pay literally double what you would be paying currently? People are just going to stay put. And when old houses sell for more than new houses, the system is broken. It's not just single family homes, though. A problem goes much, much deeper. Of course, we see a big problem right now in U.S. commercial real estate. We see the crisis deepening. Here we go again. U.S. commercial property crisis deepens with office vacancy rate topping 2008 highs. Hitting a new record. Oh boy, we got a new record, guys. We got a new record. Fantastic. That, of course, is not the kind of record you want to be achieving. The U.S. commercial property crisis is very problematic because massive institutions have massive amounts of commercial property, and no one's biting. Companies are scaling back. People are working from home more, all these kinds of things. Very, very problematic for these companies that have all this commercial property. Nobody's in it. They can't fill the space up. It's problematic in a lot of ways. And of course, it's not, we're picking on America right now, but don't worry, we can pick on China too. This is not just America, it's also China. Putting Chinese real estate markets in perspective here, if things don't stabilize, this could become the biggest bubble burst in history. And China's got a lot of problems right now. And Chinese government's working very hard to try and make sure that that doesn't happen. Trillions and trillions and trillions of dollars in residential property. $62 trillion of residential property in China. Incredible, incredible numbers here. And if that bubble pops, you better watch out, because if the Chinese property market collapses in such a spectacular fashion, there's a lot of international exposure to that market, and that could also have massive impacts for the Chinese economy, which also has massive impacts for the global economy. You can't see housing markets completely tank in the world's second biggest economy and not expect there to be any kind of repercussions for that. And before we get into the rest of this story, just a quick note: if you have not yet signed up for the Wealth Mastery newsletter, you got to get it checked out. This is the best damn newsletter in the Web3 space. If you want to know about crypto altcoins, if you want to know about the latest cryptocurrency news, if you want to know about DeFi and NFTs and airdrops and all that kind of stuff, you got to get signed up. 75,000 people every single week are reading this newsletter, and you can too for free by signing up using the link down below. Thank you. So now let's talk about the speculative investors, the Airbnb collapse. This chart right here got a lot of play on social media recently, talking about the Airbnb collapse. Revenues are down nearly 50% in cities like Phoenix and Austin. It's pretty crazy. As Nick here points out, watch for a wave of forced selling from Airbnb owners later this year, and the areas hit the hardest by the revenue collapse. There could be a lot of forced sellers for a lot of variety of reasons, which drives prices down, and there was no buyers out there. It creates a lot of problems for a lot of people. People might have to default on these mortgages that they got. Seemed like a great idea 2 years ago. All the money was cheap. You buy a place, you fix it up, you start putting on Airbnb. Some people are going to be able to just wait out the storm here and keep Airbnb being that in the future. Others are not. Others are going to have a real problem here. Now look, while the Airbnb company is blamed for a lot of the ills of the property markets, it's not actually that impactful as it's made out sometimes to be. And as this commentator puts here, an Airbnb collapse will not fix America's housing shortage, because it is a small percentage of the total amount of houses. And we are seeing things like New York City saying, hey, you can't do Airbnbs here anymore and stuff like that, which is going to hurt Airbnb, the company, of course, and Airbnb hosts who bought these properties on that premise that they were going to make them short-term rentals. Now they're going to have to turn them into long-term rentals to try and bring housing affordability back down into more reasonable levels. But this all has knock-on effects in a variety of ways across the housing market. But then, so there's all that, everything we've just discussed. It's all very true. It's all very pertinent information. But then there's some counter information that's also worth taking a look at. For example, U.S. pending home sales rise for the first time since February. That's in late July that came in. That's pretty interesting. Now, it only rose 0.3%, but still, that's a rise. That's a rise. And it doesn't necessarily fit with the, we're in a mega Armageddon apocalypse sort of scenario. What about this story? This is an interesting one because obviously the commercial real estate story has been very, very big. Commercial real estate apocalypse coming, worse than 2008, et cetera, et cetera, et cetera. Well, the economy hasn't completely gone into a Great Depression yet. And as Mark points out here, San Francisco will soon be sold out again. Never seen commercial real estate leasing at this rate. The number of companies looking for huge amounts of space is incredible. AI companies are seeking up to 1 million square feet of office space in the city. Fascinating. Fascinating stuff, isn't it? As prices come down, buyers step in. Now, is that anecdotal story from San Francisco enough to say, hey, the commercial real estate sector is going to be just fine, everybody? Not necessarily, but it's an interesting, perhaps early indicator that things may be turning around. Guess we'll see. Here's 5 reasons that there's not going to be a housing market crash. One is that inventories are still low. The National Association of Realtors says there was a 3.3-month supply of homes for sale in July. Back in early 2022, that figure was 1.7 months supply. This ongoing lack of inventory explains why many buyers still have little choice but to bid up prices. Builders, number 2. Builders didn't build quickly enough to meet demand. Home builders pulled way back after last crash and they never fully ramped up to the pre-2007 levels. Now there's no way for them to buy land and win regulatory approvals quickly enough to quench demand. While they are building as much as they can, a repeat of the overbuilding of 15 years ago looks unlikely. The fundamental reason for the run-up in price is heightened demand and a lack of supply. Number 3. Demographic trends are creating new buyers. There is strong demand for homes on many fronts. Many Americans who already owned homes decided during the pandemic that they needed bigger places, especially with the rise of working from home. People needed home offices suddenly, potentially 2, one for the husband, one for the wife. Millennials are a huge group in their prime buying years, of course, who are inheriting like $35 or $40 trillion worth of money, as well as we see in the USA, specifically Hispanics, a growing demographic also keen to get on the home ownership ladder. Number 4, lending standards remaining strict. In 2007, liar loans, in which borrowers didn't need to document their income, were common. Lenders offered mortgages to just about anyone, regardless of credit history and down payment size. Today, lenders impose tough standards on borrowers, and those who are getting a mortgage overwhelmingly have excellent credit. The median credit score for mortgage borrowers in the second quarter of 2023 was a stellar 769. According to the Federal Reserve Bank of New York, saying if lending standards loosen and we go back to the wild, wild west days of 2004, 2006, then that's a whole different animal. But if we start to see prices being bid up by artificial buying power of loose lending standards, that's when we worry about a crash. But that's not what we're seeing right now. And number 5, foreclosure activity is muted. In the years after the housing crisis, millions of foreclosures flooded the housing market, depressing prices. That's not the case right now. Most homeowners have a comfortable equity cushion in their homes. Lenders weren't filing default notices during the height of the pandemic, pushing foreclosures to record lows in 2020. And remember too, that a lot of people who have their houses right now, they're locked into very low interest loans on average. So there's not a lot of incentive for them to sell, and they're probably going to be able to service those loans because they're cheap enough. People buying houses today at current interest rates, that's going to be more problematic, but that's perhaps a problem for future us to worry about in the markets. So while there's a lot of problems, obviously, with the real estate market, not everything is necessarily as bad as it always seems, and the calls that there's going to be an imminent super mega crash in the real estate market in the USA, perhaps slightly overblown. Still, of course, the potential for it to happen because there's a lot of moving pieces in the economy that are not looking fantastic. For example, the unemployment rate's up to 3.8% now. So if people don't have jobs, it doesn't matter how cheap your mortgage is. If you don't have any money to pay your mortgage, It's very problematic. If that unemployment rate keeps rising, let's say it gets up to 7 or 8%, for example, it'd be pretty high. That means 7 to 8% of the population who have mortgages, even if they got cheap mortgages, suddenly can't afford to pay their mortgages. That means a lot of inventory comes into the markets. Is the demand there to absorb that inventory? Remains to be seen. But certainly, while we want to make, especially the media, wants to make that comparison all the time to 2008, it's 2008, it's 2008 all over again. The numbers don't necessarily stack up to say that, yes, this is the case. I know that history can rhyme, but it doesn't repeat. And in that rhyme, we find the ability to bring in new notes. So we may not see a super mega meltdown in U.S. property markets. And if we don't, then that may help to avoid the worst possible effects of a coming recession and all that kind of stuff. But you'll let me know your opinion on this down below in the comment section. Thanks for watching today's video, and I'll see you next time.